Hi, my name is Francisco Bermejo. In this video, I'm going to dig into what has recently changed in the buy-to-let tax environment in the UK, and also I'm going to show you a way to thrive with it by turning a potential problem into an opportunity. As most of you know, a tax regulation known as Section 24 was introduced in 2017, and it has been progressively getting into place since. But now is when residential landlords can see its full impact on the balance sheets. It removes the landlord right to deduct the mortgage interest and other finance costs from the rental income before calculating the tax liability. And it has been replaced for a tax credit of 20% based on the loan and mortgage interest. Let's see the impact that Section 24 has on a property with a only interest mortgage in place. The taxable cash flow is calculated by taking all the expenses that can be deducted from the rental income. In the past, before Section 24, we could deduct the only mortgage interest from the rental income. So we will have a taxable profit of £220. However, as we can no longer deduct the only mortgage interest, the taxable profit would be £470, even if this is not the real profit. Therefore, in a year, we have a taxable profit of £5,640 versus the £2,640 that we will have in the past. Here, I calculated the net profit that the residential landlord would have in the past with this specific property versus the nowadays net profit, taking in account two scenarios. In the first one, the landlord pays 20%, and in the second one, the landlord pays 40% of their personal income. In the past, the net profit of a 20% taxpayer after paying the 20% of the yearly taxable income, which is 528, would be 2,112 net profit. And the net profit for a 40% taxpayer after paying the 40% of the taxable income would be 1,584 in this case. Let's take a look how it works now. Without deducting the only interest mortgage, the taxable yearly income is 5,640. So 20% taxpayer would pay 1,128 in taxes, and a 40% taxpayer would pay 2,256. On the top of that, they both need to pay the mortgage, which is 3,000 per year. But the government gives them a 20% of interest relief, which is 600. So the net profit of a 20% taxpayer is exactly the same than in the past, but the net profit of a 40% taxpayer has been cut in 600. But doesn't mean that if you are a 20% taxpayer, the Section 24 does not affect you. The answer is yes, it does. And the reason is because your gross income has gone from 2,640 to 5,640 per property, which is nearly, well, not nearly, is more than double per property. So if we see the bigger picture, we can see how the Section 24 can push you very easily from being in the basic rate and paying 20% in taxes to be in the higher rate and pay 40% in taxes, or from 0% to 20%, or from 40% to 45%. So if you want to determine if Section 24 affects you, I recommend you to study the case with your accountant, and not only the current circumstances, but also your future financial plans. Because if you think about acquiring more properties, or it's likely that you have a salary raise, or you would expand your self-employed income of any way above 50,207 per year, you will go from 20% to 40%. Or you might think, even if I go to 40% taxpayer, the higher rate, I would be still okay, because even if my profit has been cut 600 per property, my numbers are still green. But this is the case with this specific property. In other cases, the numbers can go from green to red. Here we can see the numbers of a 10 properties portfolio that includes buy-to-lets and HMOs provided by the site group. In the first column, we can see the numbers before the Section 24. Then we can see 3 columns that represent the numbers during the transitional period. And the last column is how the numbers are right now with the Section 24 fully in place. So we can see that the net profit after tax per year in this specific portfolio was 19,600. Then during the transitional period, this number were getting down. And right now, if the owner of this portfolio wouldn't have done anything about it, he would be losing £2,550 per year. So what can we do about it? One option is just taking the hit if we can afford it for the sake of the capital growth. However, we need to be very careful with this option because we might lose our ability to remortgage. Other option could be just giving up and selling, or we could run the property as a service accommodation. This way, the income would be legally treated as a self-employed income. And Section 24 does not apply to self-employed income. A service accommodation is a property that instead of being rented to long-term tenants, is rented to short-term guests. Most people think of tourists when they hear this. However, tourists are only one of the 12 guest types and not a strong one in most of the areas. The strongest one and the one that I personally focus are contractors and corporative clients. If you decide turning your buy-to-let into a service accommodation, there are two options. One, you could do it and manage it yourself. As long as you got the time, do not mind the hassle that it involves, and are willing to take a training to do it properly. It could be a good idea because it increases the cash flow considerably, but you need to keep in mind that you will be replacing passive income for a new job. Other option, if you prefer to save time, the hassle, and keep the passive income, you can use someone else who can do everything for you. Doing that has a lot more benefits than just avoiding the Section 24. And that's what I said at the beginning of the video, that we can use a potential problem as an opportunity. Apart of avoiding the Section 24, you wouldn't have void periods or the need to deal with the tenants not paying the rent. Instead, you will be dealing with a long-term professional tenant who will pay the rent on time every month and will take care of the rest. Also, the property will be inspected regularly and put back into show home conditions. The small maintenance issues would be dealt without even bothering you, and many major maintenance issues would be prevented. It's not like having long-term periods without even knowing what the state of the property, like when you have long-term tenants. But probably the most attractive benefit is that you might be eligible for claiming capital allowances. Capital allowances are a form of tax relief on eligible plant and machinery that is typically claimed by factories, but can also be claimed for service accommodation properties. A proportion of the purchase price can be deemed as a payment for the plant fixtures that were in place at the time, no matter how long ago you bought the property. The proportion is typically around 25%. The integral plant fixtures, including items needed for your business, the cost of demolishing plant and machinery, fire alarms, CCTVs, fixtures including bathrooms, suites, integrated kitchen equipment, installing plant and machinery that requires building adjustments, or heating system, air conditioning, escalators, water systems, electrical systems, external shading from the sun. All of these can be deemed under capital allowances. So let's say that you bought a property for 400K and you get a capital allowances worth is 25%, which is 100K. And with this property, you make a profit per year of 20,000. That means that you will count the capital allowances as expenses. So the taxable profit will be minus 80,000. So you will not pay taxes this year. Then you will carry this 80,000 to the following year. You will make the same profit. The balance will be minus 60, and then you will not pay taxes this year neither. Then you will carry this to the following year. The balance will be 40,000. So another year without paying taxes, you will carry the 40,000 to the following year. You will make the same profit. the balance would be minus 20,000 and you will not pay taxes again. Then you will carry the minus 20,000 to the following year. Then you will have the same expenses, let's say, than the profit. So the balance will be 0 and you will not pay taxes. And the following years, you will go to normality. What means that in this case, you will have 1, 2, 3, 4, and 5 years without paying taxes. However, claiming the capital allowance is not simple. It needs a complex valuation process and also professionals getting involved. So it requires further information and guidance. Times have changed, and I'm sure they will keep changing. We cannot control the environment, but we can control how we adapt to the environment. We can keep updated, keep learning new skills or using someone else's, and be open to new possibilities, so we can take the opportunities when they show up. Thanks for watching. I hope it was useful, and if you have any questions or are looking for someone to convert your buy-to-let into service accommodation, I left my email in the description below. Bye for now.